In a very volatile and uncertain world, it must be getting very difficult to make a prognosis around what the economic impact of moves can be, especially if these moves happen in the blink of an eye, once a day or maybe twice a day as well. So it makes Sonal Verma's job very difficult. She's Managing Director and Chief Economist, India and Asia ex Japan at Nomura. And Sonal, great having you. Thanks for taking the time out and being with us. Just trying to understand how difficult is it right now to write a note for 2026, considering that no one knows anything.
Every year is sort of similar. Uncertainty is very high, but you're right. I think in the last 12 months, just the speed with which policies are changing has made life a lot more difficult. But we try to do our job.
Actually, before we get to the brass tags and the numbers and your thoughts, just trying to understand, I was listening to a comment from External Affairs Minister S. Jaishankar, who said that a lot of government to government or country to country affiliations slash tie-ups, etc., might now happen not because of economic sense, but because of the political comfort that a leader may have with the other or a country may have with the other, even if it may not make complete economic sense. I wonder if that is something that now would take precedence as you try and figure out what the economic impact over the next 12 months of policy making could be.
Yeah, I think that's quite interesting and important. I think, like in general, over the last many years, this geoeconomic fragmentation has been ongoing. And in the last 12 months, with US, trade policies being sort of more negative, I would say, for the exporter nations, what we have seen is one, many countries actually trying to find new export destinations. So there is sort of this push towards diversifying and hedging against just being solely reliant on the US market, which is sort of more from an economic perspective. But the second bit is also in terms of aligning with like-minded partners and putting sort of domestic national sovereignty as a top policy priority. So we've seen sort of, BRIC nations come together. We've seen some patching up on India-China relationship as well, which has been sort of a positive development relative to expectations. So yeah, I think given the challenging world we are in, what each country is trying to do is really put its own interests first.
Sonal, hi, Tamanna here, and great to speak with you. I think one big question mark is the trade deal, right? We're looking like we're closing 2025 calendar year without a trade deal in place. Meanwhile, trade deals which have already been negotiated with the United States look like they're collapsing, or there's a backtracking or lack of clarity. How big a factor do you see this for India economically going into the next year, considering that some of that pain on exports and the rupee are beginning to show?
It is beginning to show, but I think all said and done, actually, overall numbers have turned out to be better than expected despite the higher US tariffs. So there's a segment of MSME exporting firms which need more support because of these higher tariffs. But I think we've seen enough offsets from other economic channels to negate the impact. Now the deal is taking a lot longer than expected, and given next year is going to be more about U.S. midterm elections, politically the agriculture sector is also quite important from the U.S. perspective, and for India, of course, it's always quite important. The one change, though, is India's imports of Russian oil should come down because the sanctions are now into effect. So to that extent, there is still this window for at least the 25% additional penalty to be removed, given India's imports from Russia, oil imports from Russia are coming down. But I think overall, it is an issue for the labor-intensive sectors. They will need some hand-holding. But I think businesses are sort of just going about their business and doing sort of more medium-term planning rather than waiting for this to completely resolve. As is the case with India's approach. I mean, we are out there negotiating free trade agreements with all other countries while trying to, negotiate the trade deal with the US. So I think it's negative, but things have been much better than one had feared.
And that's, I think, shown in the Q2 GDP numbers. Just your reaction to those numbers, Sonal, and are they truly reflective of what we're seeing in India right now?
I think, like the low deflators have amplified the real GDP numbers this year. And therefore, when we sort of look back into 2025, while we've actually had to upgrade our real GDP growth projections, I think in terms of the underlying momentum in the cyclical economy, to our mind, that has been soft. So some of the more sort of consumer discretionary segment demand through the course of this year, has been soft. Of course, the pivot point came through once the GST cuts got announced. But I think 2025 has really been more about cyclical demand softness in India. And therefore, to some extent, the real GDP numbers are, in our view, being amplified by the low deflators. But as we look out to 2026, we are more positive.
GDP outlook that you have for India, what's the number you have in mind for 2026?
Well, 2025, first of all, we'll end up closer to 7.5%. In fact, we should end 2025 calendar year close to 7.7%, because even the October-December 2025 quarter will see real GDP growth of at least 7.5%. So we will be ending on a fairly solid note there. As we look out to 2026, our own forecast is growth of around 7%. We are forecasting a 6.9 for CY 2026. And as I said, I think some of the disconnect between the strong real GDP numbers but soft high frequency indicators, we think will sort of course correct over the next 12 months. So even though our real growth projection is a bit lower, we think the underlying cyclical demand in India should improve going forward.
Sonal, I'm presuming that, a lot of talk around how lower inflation and therefore the lower nominal numbers are a bit of a worry. Is it, to your mind, to an optimist or somebody who looks at a glass half full, it is maybe, yes, the GDP numbers might be high because of the low base, but it's still a good number accompanied with lower inflation, giving the RBI the ammo to cut rates. It's not that bad a space. So is the optimist right, or is it better to be a bit skeptical on this?
I think, it's a good situation to be in. I think many countries would like to have 8% growth and very low inflation. So it is actually an envious spot where India is. Now, the disinflation in India is caused by many factors. I think the low food prices, at least the volatile components of food, can mean revert. But the analysis we've done shows that there is also a structural element to the disinflation in India, and particularly some of the core categories, which historically have been sticky at 5.5%. The trend in the core categories has also moderated to less than 3.5%. So while the food side can rebound, there is a durable element to this low inflation. So it is actually in a good it is a good spot overall from a macro perspective. There are consequences of very low, nominal GDP growth, particularly for a country like India. The tax collections are linked to nominal GDP growth. Corporate revenues are linked to nominal GDP growth next year. As you know, we are moving from a fiscal deficit targeting to debt targeting, and the gap between your nominal GDP growth and your nominal interest cost is one of the factors that will determine the pace of moderation in debt to GDP. So I think, there's sort of positive, negative, both factors. For India's stage of economic development, I think we need the right balance. So if you look at 2025, on average, inflation will be a shade above 2%.
Right.
And 2026, we are expecting around 3.5%. So very low inflation is also not good for food producers. So some balance is important.
That's true. That's true. Sonal, one quick word. I mean, if the Fed were to cut, and if the incoming Fed is perceived to be dovish, as per Donald Trump's wishes, right? Does that give enough ammo for the Reserve Bank of India to stay put with lower rates, which might help corporate capex, so on and so forth, for the foreseeable future?
I think in general, RBI's reaction function, Fed policy is probably not in the first, 2-3 factors in terms of what determines RBI's policy. So, the outlook on inflation, the outlook on growth, continue to be the predominant factors. In fact, what we are seeing, not just in India, but across a lot of other countries in Asia, is that central banks are not simply following the Fed because, the growth outlook is very different, the inflation outlook is very different. And therefore, each economy is doing what is necessary from its own perspective. Now, from India's perspective, if inflation stays benign, then that does offer the RBI space to ease further, irrespective of what the Fed does. And I think it's important to understand that, in a flexible inflation targeting regime, as long as currency depreciation is not threatening your inflation mandate, it is manageable. So in India's case, despite the currency weakness we've seen, inflation, in our view, will stay below the 4% target at least till September, November of 2026. And we have more than sufficient FX reserves to manage the volatility as well. So the predominant driver, therefore, remains the domestic growth inflation dynamics. I don't think the Fed outlook materially changes that view.
Yeah, fair enough. In terms of room for more cuts for the Reserve Bank, do you see that propensity at all? And do you see the dollar or the rupee versus dollar recovering if there's no clarity on a trade deal anytime soon?
Yeah, I think in terms of space for RBI, 125 basis point is already done and in the bag. So when we look out to 2026, we do think that the rate cutting cycle is not over. There is still some room, but the RBI, has the luxury of going a bit slow from here. So we're expecting the pause in February meeting, and we're expecting a 25 basis point cut in April. So we are expecting a 5% as the terminal rate. What will be more important for the RBI now is essentially ensuring transmission. So some of the durable liquidity injection measures that were announced in the December meeting, we do expect more open market bond purchases to be announced early next year. So transmission, both via the bank lending channel and through the market channel of transmission will be a bigger focus. So we do think that the overall outlook on interest rates and the monetary conditions in India will be favorable next year. On the currency, I think, a trade deal now would actually be a positive surprise because a lot of people have been waiting for it for very long and have sort of given up. So I think the announcement of a trade deal itself would be positive. The biggest challenge for India in 2025 has been, that we are not an AI story. And B, the cyclical slowdown that we've seen in India. So if you're right and the easy monetary conditions do lead to a pickup in cyclical growth, then India can actually get more equity inflows next year. And there's also potential for bond index inclusion next year. So, flows returning, current accounts staying around 1% of GDP should mean that the balance of payment, will be easily funded. So I think the external sector should be less of concern compared to the challenges we faced in 2025.
Okay, so net rupee might not be such a big concern, and US-India trade deal could be a positive surprise. Sonal, thank you so much for speaking with us. Always a pleasure to hear from you. Sonal Verma, of course, is Managing Director and Chief Economist, India and Asia ex-Japan at Nomura.